Hello and welcome to today's show. Today we're going to be talking about investment options, which I suppose is another way of thinking about all the different things out there that you could potentially invest in and trying to navigate through that. Before we start, I just want to say that because we're talking about specific investments, nothing you hear today will be financial advice. We're not going to give you advice about what to buy and what to sell. And also we may talk about specific investments, so we might name some specific investments. And again, that's not a recommendation to buy or sell anything. Okay, well, today my guest is Faith Archer, who is a financial journalist. Welcome to the show, Faith.
Thank you, glad to be here.
Good. Perhaps if we could just start, before we come on to this kind of idea of the options for investing, perhaps you could tell us a little bit about you and how you've come to be doing what you do today.
Okay, well, I write about money. So I've been a personal finance journalist for the last 14 years. I write a column about money for Women in the Home, and I'm also a money blogger at Much More With Less.
And the interesting thing, I remember reading one of your articles probably 2 years ago, the interesting thing that sort of drew us together, as it were, was your article about cash and how you decided to move away from cash. Can you tell us a little bit about that story?
Yes, I think the amusing aspect is somebody who's been writing about investing for 14 years, but yet it was relatively recently that I actually put any of my own money into investments aside from paying into a pension. So I think it was only about 3 years ago that I finally got fed up with how low interest rates were in cash and put some money into the markets and bought some investments.
It's interesting, I was reading a piece actually in one of the consumer press titles just the other day about the fact that the Bank of England data is showing that interest rates are about 0.4% that you can get on savings currently, and of course inflation's running up to like 2.7% currently. So even holding that cash is sort of taking you backwards. Was that kind of what was driving you, really?
Yeah, it was the frustration that if I'd worked hard to build up savings, and if I left them in a bank account, I was going to be able to buy less in future because interest rates just weren't keeping up with inflation.
Okay, well, let's talk about investment options. I mean, the first thing really on my mind to ask is, when you started that process of looking at investments, there's just so much out there. There's so many different options. How did you kind of navigate? How does one navigate through all of that?
Well, I think one of the big choices if you're going to invest in the stock market is starting off by thinking about, do you want to invest in individual shares or do you want to use funds? So shares, that's when you buy a stake in an individual company, a high street name or a big oil company, something like that. With a fund, you hand your money over and then it's spread across lots of different companies or even different kinds of investments. I'm convinced that if I went for individual shares, I would be bound to pick a company just before I went straight down the tubes. So I would rather use funds and pay somebody else to spread my money across lots of different choices, and therefore hopefully it will be slightly less risky.
That's of course one of the great things about a fund manager, a man or a woman who's paid to manage that money for you, is that you're kind of handing over that responsibility to them. Didn't you feel nervous though about you still got to pick a fund manager? How did you decide who was a good fund manager and who was a bad fund manager?
Well, given that I am fairly risk averse, I didn't want to put my money with somebody perhaps that hadn't been managing it for a very short amount of time, hadn't experienced different booms and busts and recessions, that kind of thing.
So experience was really important.
Experience was very important to me, and although past performance is no guarantee of how it's going to do in the future, I felt a certain comfort level in investments that had, held on in there for a long time. And there's actually a bunch of investment trusts that have been paying dividends, that's kind of income on your investment, for more than 30 years. And some of them rising dividends for more than 50 years. And so I thought, well, if they've managed to keep going that long, they're probably going to want to carry on paying an income in future, and that might be worth a punt. So I started off with that list, the AIC Dividend Heroes, and narrowed it down from there.
So just to be clear, an investment trust is essentially a type of a fund. It uses a fund manager to pick and choose investments for you, but it's structured slightly differently from an investment fund. Without getting into lots of sort of intricate detail, can you just tell us what the 3 or 4 maybe key differences are between an open-ended fund, an investment fund, and an investment trust? I'll kick off with one. So I think one of the really important points about an investment trust is the point you've made about dividends, is that if you have a fund manager managing an investment trust, he can squirrel away money in the good years. And the rules say, actually, you can keep up to 15% of the income you receive as a fund manager who's investing in all those individual companies each year in an account, in what's called a revenue reserve. What that means is in the bad times, when we had the financial crisis perhaps in 2008-9, fund managers were able to dip into those reserves to keep paying out their dividends to investors. And so that's why some of the investments you're talking about in the Association of Investment Companies list, their Dividend Heroes list, have been able to do that for such a long time, because in the good years they're keeping a little bit back to pay out in the bad years. And that's something that only happens in investment trusts and is a really key feature really for people thinking about consistency of income, because if you are investing for income and you want to live off that income, for example, if income goes up and down over time, then that could be a problem to you. Whereas if you can potentially think about a consistent income, then that might help. So that's one of my favourite features of an investment trust. What else would you put on that list?
I think another thing that helps investment trusts really plan for the long term is their structure, because investment trusts themselves are companies that are listed on the stock market. So the way you invest is by buying shares in that company. And the difference that makes is that the share price can go up and down depending on whether lots of people want to buy the shares or not so many people want to buy the shares. And that's actually separate from the assets held by the investment trust, from the companies that it chooses to invest in. With a unit trust, if people don't want to buy it so often and they want to get their money back, the unit trust manager, the open-ended fund manager, potentially has to sell assets to give the money back. Whereas with an investment trust, the manager could just keep the assets and the share price might go down, but he can carry on investing in the assets that he believes in. And I think that makes investment trusts a very good way of taking a long-term view. You're not going to have to sell the things you've invested in a hurry. It might be particularly good, for example, investing in property. That's, if you buy a big hospital, you can't really sell that tomorrow.
No, true.
And it might be good for early stage companies that aren't listed on the stock market, so it's not so easy to buy and sell chunks. And I think for me, that's one of the things that I think can help investment trust managers take hopefully good decisions for the long term, without feeling they're going to have to sell things in a hurry.
So those investment trusts and investment funds are both what we call actively managed funds. There's a human being picking the companies that they're going to invest in. But there's another type, isn't there? Passive funds. How do they work?
The idea of passive funds is that they don't try and pick and choose. They don't try and beat the market. They just try and follow it. So what they will follow is typically called an index. So that represents a basket of companies. So you might have heard of the FTSE 100, which is the index tracking the prices of Britain's biggest companies. And because there's no picking and choosing involved, which is just trying to follow an index, passive funds, also known as trackers, can be run by computer. So typically their charges are a lot lower.
And charges are really important, aren't they? I mean, they can take away from the return you're getting as an investor. I mean, do you consider charges when you're looking at your portfolio? Do you?
Very much so.
You do, yeah. Okay.
Very much so.
And I was going to ask you, how do you assess? How do you compare charges?
Well, you're always hoping that your investments are going to grow more than the amount they charge, and the bigger the difference between how they perform and the charges, the more money you will hang on to. So I invest in both active and passive funds. For the active funds, I do try and research whether I think it's a manager that possibly will do better. But even then, I will look for funds that are actively managed with relatively low fees. So, for example, a couple of the funds I have charge about 0.5% a year, and that's actually reasonably cheap for an actively managed fund, quite a lot, or 1%, 1.5%. And in contrast with passive funds, you can find those for under 0.1% a year. So that is quite a difference.
Quite a difference, yeah. I mean, I suppose the other thing to point out is, I mean, not always do active managers get it right. They don't always choose the companies that that do well and avoid the companies that don't do so well. But of course, a passive fund follows all of those companies irrespective of whether they do well or they don't well. So you are buying everything rather than just a selection, which, as you say, gives you that indexed kind of tracking nature. Thinking about assessing an investment, then, if you've perhaps thought about the option, the different options between active and passive, most of them have these things called benchmarks. How does a benchmark work?
A benchmark's just a way of comparing performance, seeing how well your investments are doing. So most funds, actively managed funds, will pick a benchmark to compare and show whether they're doing better or worse than that market. And there are different benchmarks depending on whether, say, you're investing in big companies in the UK or small companies, often emerging markets overseas, so that you can find out for any particular fund. If you look at, they each have a document describing the fund, key investor information document, a KID. If you look at that, you'll be able to see what they're benchmarked against, and they also show you a nice little graph so you can see how that fund has done relative to the benchmark. Have they done what you're paying the managers to do, which is perform better than the benchmark?
Okay, that's good. I mean, that's one of the questions I was going to come to, actually, is the documentation and the information around investment options. I mean, where are the places to go to research in the first place, but also how do you keep in touch with your investment once you've made it?
I think when you're at the research stage, often the problem is almost there's too much information out there.
That's kind of there's a real groundswell of stuff, isn't there?
Yeah, there's a lot of information that you can look at. Sources that I have looked at, there are more consumer-friendly publications, magazines like MoneyWise. There is actually a Steps to Investing website to explain some of the basics. I use things like TrustNet and Morningstar that are specific websites that have information about individual funds. For investment trusts, I look at the Association of Investment Company websites. And if you choose to invest, so you set yourself up with an account on an investment platform, then quite often they will have information about individual funds and research articles that you can read. I should say that you don't always have to pick and choose your own investments. There are investment platforms that will either recommend different portfolios or where you can answer questions and they will kind of allocate you with a basket of different investments according to how long you want to invest for, why you're investing, and what your attitudes are to whether you're prepared to risk your money or not.
And did you do some of those kind of, well, not tests, but some of that kind of formal discovery work where you worked out what your attitude to risk was and what your objectives were when you started, or was it less scientific than that?
I think I certainly did think about it at the beginning. I think for me, the big moment for me was realising that my money and cash savings in my cash individual savings accounts, I was looking on that as something for retirement.
Right.
And if that is 2-3 decades away when I'm going to need that money, the one thing that really stuck in my mind, that over a period as long as 18 years, the chances of stock market investments beating cash was 99%. And so it was just I should not be in cash. If I'm looking that far ahead, I need to invest the money. And so given that I had a longer time frame, then I was willing to take a bit more risk, because even if investments went down, there was quite a lot of time for them to come back up.
Mm-hmm. Were you worried when you made your first investment?
Yeah, it didn't feel so great when I was actually doing, I did it on computer and kind of, hit
Press
the button. Partly I think there's a bit of concern, did I put in the right code number? Am I actually buying what I think I'm buying and I've allowed for the tax, that kind of thing. So yes, it was a bit nerve-wracking.
You mentioned tax. Obviously, there are different ways of dealing with tax and different types of accounts that might shelter you from some of the tax. Now, obviously, the rules change from time to time. Probably what we're talking about today might not be the case tomorrow. Tax rules change. But broadly speaking, there are two things I think that you could do for tax purposes. One's an ISA and one's a SIPP, a pension. Do you want to cover ISA, and I'll maybe talk about pensions a little bit?
There we go. The fundamental benefit of an ISA, it's an individual savings account, and they do come in different varieties. But the benefit is you put the money in, and then it's protected from the taxman. So you can earn interest, you could earn dividends, your money could grow, but you won't have to pay any income tax or capital gains tax. And the same on the growth. And the same applies when you come to spend it. You don't have to mention it on your tax form.
Simplifies
so it makes life, you keep more of your own money, and it makes life much easier.
And I suppose pensions are similar but slightly more complicated, and pensions rules, again, change regularly, but it's a similar idea. Is you can put money into a tax-sheltered environment, so you don't pay capital gains tax or income tax on a self-invested personal pension, but you do get some tax relief. So if you're a basic rate taxpayer, you'll get tax relief on the money that you put in. In other words, for every £100 you put in, the government will give you a bit more to invest over time. Now, it's going to ask for that money back when you retire. You'll have to pay some tax when you start to draw your pension. But if you think about it in terms of the 18-year time span you talked about, you've had that money that the government has given you for 18 years working for you, even if you've got to hand back the initial amount when you retire. I wanted to cover income in a bit more detail, actually, because again, different types of investments pay different levels of income. What's the kind of comparator, and is there a level of income that you're looking for that makes an investment interesting to you?
I suppose I wouldn't necessarily go for a particular number and say, right, all my investments have to return this amount, because it's always going to be a combination of how much the investment itself grows and then how much it pays you as income, known as dividends, which you can then choose whether to reinvest in the same thing or use that money to buy something else, or use that money just to spend it, I suppose. So I think there's a balance. You are more likely, if you invest in quite big companies, long established companies, they perhaps are more likely to pay dividends. Invest in smaller companies, they may have less money going around. They might not be able to pay you so much money, but if the managers pick the right ones, you may find that the value of that company grows a lot faster.
Yeah. And so it's for you about a balance in those types of companies in your portfolio. Okay, well, I mean, that kind of takes us in a whistle-stop way through the different types of options. Lots more to discuss, I'm sure. But could you perhaps sum up the top tips, perhaps, for thinking about investment options? What would be your top 3 recommendations?
I suppose the 3 things for me would be that I preferred using funds rather than buying shares in individual companies. So I knew my money was spread over lots of different investments, and if any one of them went wrong, it wouldn't have so much of an impact. I think the second thing was taking advantage of the accounts on offer, whether individual savings accounts, ISAs or pensions, so that I could hang on to more of my money. And the third thing was keeping an eye on the charges. Because you really want to make sure that you keep more of the growth, and that if you're paying for active fund management, that you're actually getting some additional growth and dividends for that.
Sage advice. Thank you for joining us and sharing your thoughts with us today, Faith. Okay, well, that's all we have time for today. Thank you very much for watching. If you want to see more, then check out the playlists on the channel. And don't forget to subscribe to stay up to date. And of course, do check out stepstoinvesting.com if you have a moment. Many thanks for watching. See you again next time.